All right, hey guys. First full week in the market here after President Trump and the Republicans have won their victory in the election. Not here to talk about politics, but I am here to give you some insights into the market and where things are currently at. So stick with me here. I'm going to try to keep this relatively brief. Lot to cover. Not going to get to everything today, but just some interesting perspective and points to look at. So hang with me while I jump through some charts. Let's go ahead and get into it. So first I want to start, this is just a chart of the S&P 500 here, and it shows it's looking at valuation. So this is a PE multiple on the S&P 500, which is currently up near 30, which people say is pretty expensive, right? That would be historically considered overvalued. And for context, the red line is where the S&P 500 would need to be for it to be considered fair value. So this is a weekly chart. I want to go ahead and back it off though to a month just for some perspective. So you can see how long the market can stay overvalued from a valuation standpoint. And then the other thing to look at and remember is that the market doesn't necessarily need to come down for the valuation to come down. So as earnings increase, the valuation can change there. And what I think most people would agree on is that there is a bias of lower left to upper right in the US economy. And so having a long bias in your investment thesis typically is going to serve people well. Not always, but the longer your time horizon, the more you're going to want to consider being long and involved in the market. So let's flip through really quick. Here's an interesting one really fast. Again, I backed off to a monthly perspective on this. Where are things heading? The month last month was slightly negative, and so far this month over here up in this corner, we're positive in the market. Again, after Trump's win, the markets reacted well to that initially. It's pulled back a little bit, and you can see that by the kind of whisker on the top of the candle there. But one of the things to consider is down here, and this chart is now going back to 2000 and looking at 2007 and onward. And how has the S&P 500 compared in relative performance to international developed markets is this first line underneath. And what you can see here is just a pretty clear pull away of the U.S. economy and the U.S. market from international. There's been brief periods of outperformance by international markets relative to the U.S. markets, right? End of 2022 had a somewhat significant large relative outperformance. But we can see that we're continuing and from this summer really pulling away again in the developed markets, a trend that I think is going to continue to come to fruition. Typically, when you look at different assets that you would expect to perform similarly, but maybe non-correlated, you would see this line kind of bounce, above, like sort of like it did back here, above and below this 0% line, meaning that sometimes it's adding alpha to the portfolio and sometimes it's not. What you can see is that since about 2009, international developed markets have been a negative drag or negative alpha on portfolios. The line right below it is emerging markets, right? Something where normally people say the thesis is they can grow faster, they can do all these things better because they're emerging and it's strong growth. And I just don't see that, right? Continued underperformance relative to the U.S. economy. Again, a trend that I believe will continue. So if you do have significant exposure in any meaningful way to international markets, whether it's developed or emerging, consider revisiting that and really having a conversation with yourself about why do you have that? What's the intent of that? And at what point do you think it would outperform in a meaningful way against the U.S. markets? Rolling through, this is starting to look at what we would call breadth of the market. And so this is the advancing stocks and declining stocks. So this is a daily chart. And this just shows on a daily basis how many stocks have been advancing versus declining, right? So red would represent your decliners, green represents your advancers. And the idea is that, stocks, you want to see stocks go up in general. That indicates a healthy market, kind of when everything's going up together. We back this off to a weekly chart, and we can see that we've had some kind of negative divergence there, and somewhat of a narrowing market. Just this last week, some sell-off in the market, but nothing crazy, and nothing so wildly out of balance. Right? There's been lots of periods where the market has had just a broad sell-off, and things continue on. And at some point, you need the market to go through that kind of cycle and stuff to get repriced. This is a different way of looking at it. This is new highs versus new lows. So how many stocks are making new highs versus new lows? And you can see that, it's not great. But down here, this is going to show how many of the stocks, and the green ones in particular, how many stocks in the S&P 500 are above their 200-day moving average, right? So 68% of stocks. And then how many of them are above their 50-day moving average? 55. So that means is like 68% of the stocks are holding strong on a longer-term trend, 55 on a shorter-term trend. And what you start to see is in periods where it dips down much lower than that, we start to see our recovery points when we're in a bull market. Which I do believe that we are in a bull market. Not to say there will never be volatility in a bull market, but I think markets continue north to here from here in a meaningful capacity over the coming months and years is my thesis. Put call ratio. So this is just saying how many people are buying insurance against loss versus buying insurance against missing out on gains. So a call option is going to be somebody saying, hey, we want to buy an insurance policy that if the stock market really goes up, we want to have those gains. And a put is the opposite. Hey, we want to buy an insurance policy that if our stocks go down, we don't want to have that loss. And so what you see is the put call ratio is as this goes down, there's more people, excuse me, more people buying calls. And so a lot of people had just kind of piled into the market, a lot of FOMO this last, several days. And that's bottomed out and people are starting to buy puts as, the market hasn't delivered the euphoria results maybe that some investors were looking for post-Trump victory. The name exposure index from the National Association of Active Investment Managers, positive, a little bit over its kind of average trend. And then flipping here, here's an interesting just thing to keep an eye on. The relative performance of the price of lumber versus the price of gold and what's outperforming. This is an interesting indicator developed by a guy named Michael Guyad. He's a very intelligent CFA. He's written some papers on this. And the thesis and idea of this is that it's a leading indicator because lumber is a proxy for housing starts. So when people are building homes, lumber has to be purchased. That shows up in the futures contracts of lumber value. And so when lumber is outperforming gold, it means people are buying homes or building new homes. And they're not as worried about owning gold, which would be that flight to quality kind of quasi risk off asset, right? As gold starts to outperform, though, that would be a leading indicator that, hey, housing is not getting built and people are starting to maybe focus more on owning gold as economic insurance policy for themselves. And you can see here in, this was 2020, the price of lumber. So as this chart goes up, that means lumber is outperforming. And we all remember the run up in 2020 and 2021 on lumber prices, which did come down briefly and then had another kind of spike up at the end of 21. And since then, gold has largely been outperforming. But there does become sort of a bottom to that, right? It can only outperform to such a certain extent. And historically, it's quite a bit. Gold's outperformed on a relative basis for quite some time. So looking for that to potentially mean revert, this blue line is just a simple moving average of the last essentially 10 years of data. So where should kind of that relative performance historically sort of land? Looking at energy and oil in particular, right? There's a lot of thought about Trump winning the election and what does that do on the markets. If you look at this, these kind of semicircles here, this is just a simple cycle analysis, and it represents the 4 years of any presidential election. So right here, this would be Biden's presidency, and the black lines being the price of oil. The other one's Trump, and then, Trump, and then this would be Obama era, and then Bush. And so what's interesting is I see a lot of stuff on Facebook about, hey, remember when Trump left office, gas was XYZ price, it was $1. Well, we had this shock in COVID, and it was really just still recovering. Fuel, or oil by proxy, actually had really increased since Trump took office, on a real basis there. But I guess I show this to say there's not any definitive policy that I think is going to affect the price of oil too much. Remember, the lower it gets, the less incentivized people are to pull more of it out of the ground, which then keeps the prices high. If the prices get too high, there's an old saying in commodities, nothing fixes high prices quite like high prices. Reason being is if the Trump administration did enable a drill baby drill policy, well, what would happen is when the prices get up here at $140 a barrel, or even $100 a barrel, they're going to drill more of it, which more supply coming to market. If you remember back to Econ 101, more supply is going to lower the price because it's more supply than the demand, and so it's got to find the new equilibrium. And then bottom chart here is natural gas. So, natural gas kind of below its kind of 10-year average on nat gas prices. Nothing super notable there. Let's talk about mortgage rates though really fast. One of the things that I do talk to a lot of people about is, buying a home. And should I refinance my mortgage? Should I wait for rates to come down? What should I be doing? And I could do a whole podcast episode on that. However, I want to talk about mortgage rates in particular. This is a chart showing the 30-year mortgage price. This is a 30-year mortgage index, and we're looking at the last couple of years of data here. And what I see when I look at this chart is a couple things. This red line, when interest rates came up, they did trend up, and you had a new high in the MACD histogram down here. And that was, it's on its way up. It's trending up, and it made another new high. However, that new high wasn't confirmed by the MACD, right? So you would call that bearish divergence if we were looking at stocks or something to that effect. Bearish divergence. It just means it's not being confirmed. If this had been confirmed, I'd probably have a different thesis. If the MACD was higher than it was back here, I'd say, hey, interest rates might be indicating that it's going to go quite a bit higher. Now, here's an interesting thing is if you kind of flip the backside of that and say, well, after we came down off that high, we sort of have a different trend pattern over here where we put in this low, we kind of rally back up, and then we put in a new low. So now we have a lower low. But that's also not being confirmed by MACD. That has what you would call bullish divergence, which we're talking interest rates, so it's kind of inverse, but it's not being confirmed by the MACD. Now on this one, it is being confirmed by the relative strength indicator up here, but not on the MACD, which means, is it going to go to another lower low? I don't really think so. I think generally for the foreseeable future, the likelihood is this green box that I've highlighted is probably a pretty reasonable trading range of where interest rates are going to remain and fluctuate due to various reasons. But that being said, that means that if you can get an interest rate in the high sixes here, you're probably looking pretty good. And if interest rates get up over 8, or the closer they get to 8, you're probably on the high end. And so right now we're, the index is coming in at 6.78. It may be if you've been waiting to buy a home, this is, a fair enough interest rate in the given environment that you may not wait too much longer to try to time these rates. Continuing the rate conversation, let's look at long dated government treasuries. 30-year mortgage is based off of kind of pricing off the 10-year treasury. Let's look at TLT, which is 20-year government treasuries. which have just been a negative drag on portfolios pretty much going back to 2008. And during that whole period, they have just underperformed the S&P 500 on a relative basis, essentially the entire time, and have added really no meaningful value. There's one little peak here, and that is COVID, where they added, what people would call the crash protection, right? A couple of little peaks here where for just a short, brief period of time, you had that non-correlation, you had that lift and reduced volatility in the portfolio as a whole. I tend to look at this and say, how much do I want to own this as a long-term asset? How much do I want bonds in my portfolio as a long-term asset? If all I get is a modest amount of crash protection in a short, volatility event, is it better? Can I easier weather that storm if I don't have the bonds and I just was making a more reasonable gain to begin with, right? Everyone's got to answer that for themselves, but that's sort of the question I sometimes think to myself. Again, we're looking at a monthly chart on this. So this is a long-term trend here. We're going to start with the long-term in mind. There's a lot of resistance here where there was support and base. When this broke down in 2022 below that really in this green zone becomes kind of a spot that it's going to be hard to get back above that. And if you see, there's been a lot of volume the last couple of years into this fund, trying to push it up above those prior levels, and it just can't do it. This is not a good looking chart that you want to be involved in. Now, you may be able to make the case to say, well, you may have a bottom here, in October of 23, and it's since then trended up in a favorable direction. I'm not sure that I really believe that. It's a little bit more evident on a weekly chart than a monthly that could be the case. But again, we have this breakdown below that, and I would anticipate, again, so we put in a low here off the top, and we try to rally back up, and we end up putting in another new low, and trades a little sideways, and then hits a new low, and rallies back up, and then it hits that new low on sort of that same similar trend line. And you're getting a lot of confirmation from other indicators saying that this is likely going to be a result of rising interest rates. And when I look at something this long term in nature, right, this is going back to 2020 now, this starts to feel like more of a structural change to me in interest rates than a cyclical change in interest rates, where, interest rates went up, but they're just going to come back down, and we'll be back on this pathway northward in bond funds. So I would say be cautious, and if you have long bonds and bonds in your portfolio, I encourage you to ask the question, why do you have them, and what purpose are they specifically serving? And if the purpose is to give you a little bit of crash protection but lose you a bunch of money every day along the way, I don't know that that's the right answer or the good answer you might be looking for. Here's just a zoomed in. This is a weekly chart of the same thing. This is that trend line we looked at in the other chart. Again, here it is going up, but a violation of that trend line a couple weeks ago, and this is not looking too good for long bond return. It indicates higher yield or higher interest rates, which again, if that does find its way into the 10-year, it's going to be significant. Let's talk about something a little bit more, interesting to some people here these days, and that's Bitcoin. Bitcoin earlier this year hit an all-time high back in March, and then started. This is what we would call building a base. It hit an all-time new high on a rally, and eventually, started a sell-off, and then it rallied back up, trying to hit back to those highs, and did that a number of times. What you saw, though, is that it started putting in lower lows on those sell-offs after it failed that attempt. And then eventually, if you kind of draw this sort of trend line across here, in August, all of a sudden it had a lowest low, and then the next sell-off, it didn't get as low, which means now it's putting in a higher low. And that's when you're able to kind of pick up the chart and say, okay, I believe this could be building a base. It would still be too early to get in that trade. Now, in hindsight, great buy point, right? but hindsight is 2020, and hindsight has a ton of risk. So this still wouldn't have been a good entry point for most people looking to trade Bitcoin. But as it went up higher, again, it rallied back. It goes up, it hits kind of the prior high, rallies back down, and then it breaks out above some of those failed attempts. And then back here is really interesting. As it got closer to the election and pricing in that Trump victory, it rallied up to the prior highs, but again failed. But it did have what they call a golden cross, which is right here on the chart. And that is a 50-day moving average moving above the 200-day moving average, showing a recovery. And a lot of people take that as an indicator of a new bull market. So you have the crossover. It comes back, it corrects. And then on the Trump victory, pricing in here, boom, it hits a breakout. Now, if you haven't gotten in this trade, here's why you have to be careful. There is no level of support below this at this point until you get back down to 73,000, which for most people is a pretty significant drawdown. So be cautious, I would say, on getting involved in Bitcoin at this point. But there could be another good entry point in the future if you monitor it correctly. Some good signs that I like on the breakout is a good follow through on volume, confirmation on volume, confirmation on the RSI. As we hit the new highs, we had a good confirmation there. A huge rise in on balance volume, especially leading into and through that breakout. It's a great sign. Your MACD moving average convergence divergence confirms the new highs. You have confirmation there, so a lot of confirmation from a number of signals. And an ADX that is really moving up. That had moved up from about 20 up to 40, showing a really strong trend kind of growth there. So something to keep an eye on. And then let's move into the sectors really fast on what's going on there. There's a relative rotation. So, hey, relative to the S&P 500, how are the different sectors of the economy kind of performing? Or not of the economy, but of the different industry sectors that make up sort of the economy, if you will, right? So you can see that XLU, which would be utilities, is weakening, real estate weakening. XLV is your healthcare, really lagging behind the market, as well as consumer staples. And those things kind of lead towards some growth in the economy, some growth expectations. So you have your leading sectors would be financials. Really took a nice leap on the Trump victory there initially. Industrials, consumer discretionary. Big major component of consumer discretionary would be Tesla. XLC, which is your communication services, and so a lot of tech stock in there too. But here's the one that I find a little bit interesting is over here, XLE. It was lagging behind the last several weeks, and it's starting to what they call it's improving. Once something's improving, it has a really good statistical chance behind it, or probability of moving into not only continuing to improve, but actually to move into leading. So last thing I'm going to look at here is just XLE, which is energies in the S&P 500, and what am I seeing in that sector, and what's the potential setup. So this is looking at a weekly chart of energy. So this is, over here, this represents the last, 6-7 weeks kind of here, and what's been happening with energy. You can see that energy has a relatively significant amount of volatility, and it has periods. Remember, if we go back earlier on the international conversation, you want to see periods in an asset where they outperform in a meaningful way. And then there's going to be periods where they underperform in a meaningful way, but you want that to be coming at the cost of there are periods where it does outperform. So that white line in the middle is a zero, and you can see how it kind of, in early 2022 and early 23, XLE did outperform the S&P 500 in a pretty meaningful way. And then it did lag. 24 has been a tougher year for XLE or energy. But we may be seeing a sort of a change there. I would say right here, this is where I start to see a little bit of a change. It's small. It's hard to see maybe on the screen. But right here on this September 9th data point, there's a low. And as the market, as the strength comes up and then comes back down, when it comes back to a low, it doesn't hit the same low. It puts in what's called a higher low, which is a good bullish divergence for XLE aiming to outperform, which since then it has, although it remains to be seen how much and for how long. Something I don't like is that the ADX is pretty flat, indicating there's no real trend in this. So we're looking really for now at this point somewhat of a mean reversion idea or a catalyst in the economy or news that would push this into a real breakout. Top green line here would be your prior all-time high, and you're looking to break out above that. Before that, you have a lot of resistance. So right now where XLE is at on this purple band, it's 2 standard deviations above its 20-day moving average. So it's a little bit extended in that sense. Or not 20-day moving average, but at this point, a 20-week moving average, so a weekly chart. And it's below, kind of right below that all-time high. So I think where I look at this chart and say, I don't really know, and I'll say too, this move up is on lighter volume, below what I would say is probably below average volume. So I would be looking, this is an interesting idea, something to pay attention to. There's a lot of economic implications of energy starting to outperform. That being said, I'm not sure that it's on a breakout and that it's quite ready for a trade. I think you'd be taking a lot of risk at this point to enter this trade, and that risk being that you get in here around $95, $97 on the fund, and all of a sudden you can see a pretty quick pullback or throwback of trend down to $90 or even down to 2 standard deviations below, which would be closer to like an $85. So you can take a pretty quick loss on something like this without controlling your risk on the entry. So, monitor the setup if it's something you're interested in taking a deeper look at. All that to be said, there's a lot of stuff going on in the markets, always something moving. Go ahead, reach out anytime. Happy to talk you through what I'm seeing. Happy to do an analysis on your portfolio and give you my opinions and do what I can to guide you through. Go ahead and find us on our website, dusharmwealth.com. Message us on Facebook or shoot us an email, contact@dusharmwealth.com. Look forward to seeing you guys out there, and I'm wishing you guys all the best.
Information presented on this program is believed to be factual and up-to-date, but we cannot guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass Asset Management, LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.